Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, something that has been much anticipated, very likely, at least based on probabilities, is going to happen in the next few months. And what am I specifically talking about? That is the reduction of interest rates. So today we're going to talk about what that probability is, how it affects certain markets, certain assets, some good news and some bad news. So let's jump in and explore what happens when the Fed cuts interest rates. And as I noted, probability states 92% chance that the Fed drops short-term rates in the next few months, specifically and most likely at the September meeting. Now, the Fed meets every 6 weeks. There's a meeting coming up very soon. And again, in September, odds favor 92% chance that the Fed drops rates 25 to 50 basis points. Now, there's good news and bad news with that. The good news is mortgage rates, auto and personal loan rates will fall. That's really good. Of course, if you're going to get a mortgage, you want to buy a house, if you want to buy a new car, if you need a loan, rates will fall, all positive there. Not so good. Your savings accounts, your money market rates will fall as well. And of course, inflation could creep up. When people borrow money, that money is deployed into certain assets. And in theory, that could increase spending and of course, prop up asset prices. Some positive news on stocks. Stocks have typically risen in the 6 to 12 month period following the Fed's first rate cut. To the extent there's a rate cut in probability state September, there's very good news potentially for the equity markets. Again, odds favor in the next 6 to 12 months, at least based on study of history, in the next 6 to 12 months, markets will be higher based on a first rate cut. So let's look at what that actually looks like if you study history. So there was a study done from 1929 to 2019, and this is very good news. Look at the US stock market. On average, it has appreciated over the next 6 to 12 months after the first rate cut, 11%. If you look at the bottom of the screen here. If there is no recession, the markets return around 17%. If there is a recession, the market's still on average positive, and that is an 8% return. Even government bonds, as you likely know, there's an inverse relationship between interest rates and bond values. So when interest rates go up, which is what we've seen the last couple of years, bond values have gone down. If you have bond funds or even individual bonds, you know you've been hurting. Now, the good news again is as rates go down, your bond portfolio will likely recover and your bond values will go up. Again, inverse relationship between interest rates and bond values. So we're likely entering a very different cycle. Interest rates control a lot of the economy. It even controls, of course, corporate spending and, of course, controls consumer spending. If interest rates are higher, you're probably not going to get a new car, or if interest rates are higher, you may not buy that new house you want. So it's a good news, generally speaking, when rates, of course, go down. As I mentioned, mortgage rates drop, personal car loans drop, personal loans drop as well. So generally speaking, all positive news. That all is to say is no matter what the market does, no matter what the Fed does, no matter what interest rates do, you must have a game plan that is driven by three things. Number one, your goals. What are your goals? Remember, I asked the question most recently, if you could change, develop, or improve any area of your financial planning, what would it be? Your goals, get clarity on them. The second part is determine what your risk tolerance is on a scale of 1 to 10. So 1 would be money like in a savings account, and 10 would be a very aggressive fund or portfolio. So where are you on that risk scale? And number 3 is your family index number. That is, what is the rate of return that you need to earn now to get you to retirement, or what's the rate of return if you're in retirement that you need to live your ideal retirement life? So get clarity on 3 things: your goals, your risk tolerance, and your family index number, and ideally create a strategy to help you accomplish your financial planning goals. All that to say is if you like this video, if you saw value in this video, if you're seeing it on Facebook, on LinkedIn, go ahead and share it with a friend, or if you get it in an email, go ahead and forward it. To that end, if you would like a second opinion on your portfolio or financial situation, if you simply want a second opinion on how interest rates might affect your portfolio, even your bond portfolio, go on our website at nickelswealth.com, click on this request an appointment tab, fill out the information, and one of our advisors will reach out to you and answer your questions. And ask you a great question, in my opinion, like if you could change, develop, or improve any area of your financial planning or wealth management, what would it be? Get clarity on your goals, put a game plan together, and take action to hopefully, ideally, help you accomplish your financial goals. Thanks again for watching. Bye-bye.